All right, so we have a highlight use context. Here's the context. I had a thought we were going to go lower right after the open. We didn't. I'm going to show that in a second. We rally, and then the next time down to the same area, context changed. What do I mean by that? Well, if you open up here and you think it's going to come down to some destination below, and you think it has the ability to break out or get below a certain price, and we just open, the context is limited because you just open. So we don't do that, and we end up rallying pretty decent. And then we come back down to the scene of the crime and rotate a little bit. Now you've got some context. You could look and say, you know what? Everybody else that was bearish probably just got shook out all the way up to here. So now this time down here, there are less shorts than when it was trading at that price that time. So you have to take that into consideration. All right. And you can't also think it's going to be going down all the way up. You have to be wrong much sooner. All right. So let's clear that. And let me show you here on, I want you to look on all the longs that open up and try to cover for small profit. All right. I'm going to play it right there. You see how these popped up? These gray lines that we added at the end of last year show exits of long positions. When they come in and pretty much come in right on top of where the long positions are in, there's just a high probability they're going to take out the bottom of this congestion and rotation. All right. And it's just one of those, if it doesn't, sooner rather than later. Because if it should happen quick. And that's really important. The timing of when something should happen and the sooner it's supposed to happen gives you a better idea of if it's going to work or not. If you have to wait always a long time to know whether or not your decision, your trade is correct, there's a lot of emotional capital and a lot of indecision that goes inside of that. It could be against you 5 or 6 points, and you're like, but I'm still not wrong yet, or 5 or 6 ticks, but it's still within this giant area that you have. No, if you could be wrong or right ASAP, it makes the decision-making process a lot easier. So this green pops out with all of these grays where we have the exits. And that was, okay, this is going to be able to push lower. Another great thing happened. As it's going lower, I'm telling people, if you got this thing, write it down because you keep getting more longs coming in, trying to exit, and they're stuck. Let me just fast forward it. More longs coming in and they're stuck. Here's some shorts that come in, but we stay below it, and these longs are stuck. Shorts come in, and it doesn't even try to get above it. But too many longs are in, and they're stuck. It just immediately keeps going underneath them. And it wasn't until we first off got in here where these longs got filled and we went up, and I said, what? 62 even, where these longs and shorts had a little fight, was going to be overhead resistance. It's not any longer coincidental of why there's support resistance. So as we start moving lower, we start getting a lot of green, a lot of gray, stuck. When you get this red, it facilitates the call for the bounce. And then you plow back in with a bunch of longs, gets us bearish again. We had a level around 50, which was Friday's low, previous session low. And you can't just buy Friday's low if you want to get long or cover it, but you want to see some information that could get you to predict the bounce. And you could see my cursor in real time showing you late shorts, the little Johnnies that waited. They didn't want to sell it at 75. They didn't want to sell it at 72 or 65 or 62, but they're going to take a shot at 49. And that's when the bottom generally is in. They had a little shake with some longs coming in. I said, hold on a second. And as soon as we dipped and got above it, don't be short anymore is the call. And then you see a nice strip of red with gray dashes in there, which are exits get out of the short, which had the call sideways to higher for that period of time. So that's that entire sequence and analysis. And if you're not doing analysis that way, then Go learn how to paint. Here was the moment after the open. Did I record it? I actually started recording after it. I thought it was in here. I think it was in here that we had a chance to get hit. Let me see. No, it was actually right in here. All this green had come in and we had a chance to go lower right in here. You see all this green and gray come in. As soon as it went away, it's like, that's when I'm wrong. So I don't have to be wrong 2 points higher, 8 points higher. If you're bearish and or short, because you get all this kind of longs to fire in, you can't remain bearish if they go away. And they go away right in there. And then our laser went from green to red anyways. So that was probably not going to go lower at that point. But you're using order flow, the intent of other people's orders, opening up positions as your guide. And like I've been telling people, as you see some of this fill out as a profile, that's the profile stuff you should use, not market profile, not volume profile, other people's positions profile, tracking where prices, what prices were popular for people to get long, popular for people to get short, popular for people to puke. That's the shooting match. That's it. Everything else are distant ancillaries that may or may not help you. Too many people use price to predict price. Don't. You have to give yourself the setup of probability. And the OPP is more or less the fire in ready, aim, fire.